Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today we're sharing 5 stories. First, OpenAI's new Grove program is recruiting entrepreneurs before they even have an idea. We'll explore the IP questions and why it's being called an extended interview. Second, the FB, I found a rare forearm imprint in the Charlie Kirk case. And we'll look at 3D scanning tech versus the old school confession that actually cracked the case. Third, Microsoft dodged a massive EU fine over its Teams software. We'll reveal the tiny €2 discount that settled the complaint brought by rival Slack. Fourth, RAM just cancelled its all-electric 1500 pickup, and we'll explain why its parent company Stellantis is pivoting to a hybrid after watching its competitors' towing failures. And fifth, the Winklevoss brothers crypto exchange Gemini went public after losing nearly $500 million, and we'll explain why its stock still soared 32%. Let's start with a single statistic that might just change your entire perspective on the AI gold rush. An incredible 71% of all US venture funding this year went straight into AI. That's up from 45% just last year. We're talking about a tidal wave of cash, with AI startups raising over $104 billion in just the first 6 months of 2025. The concern here is that when so much money and talent flows into one area, controlled by a few big players, it risks centralizing innovation. We could see a future where a handful of companies dictate the direction of all AI, stifling smaller, independent, or open source alternatives. And remember, we previously analyzed how OpenAI's unusual cap profit structure concentrates a massive equity stake in its non-profit parent, a model designed to balance mission and market, but still a lot of power in one place. At the center of this storm is OpenAI, the company behind ChatGPT, recently valued at a staggering $500 billion. As we've discussed, that valuation sits under a governance model where the non-profit parent controls a huge stake. But their next move isn't about a new product for you. It's a strategic hunt for talent. They just announced a new program called OpenAI Grove, and the setup is fascinating. It's not for established companies, but for entrepreneurs at the pre-idea to pre-seed stage. That's right. They are actively recruiting people who may not even have a company yet. The new detail here is the format. It's a 5-week program with in-person workshops kicking off this fall and giving participants early access to OpenAI's latest stack. But this is where the situation takes a more complex turn, raising some huge questions about intellectual property. When a founder develops an idea using OpenAI's secret tools and with their expert guidance, who actually owns that idea? The official announcements are silent, which could mean entrepreneurs risk losing control of their own innovations. A while back, we noted how OpenAI's push into enterprise was already blurring the line between mission and market. Grove pushes that boundary earlier than ever. They are trying to get inside the next big thing before it even exists. Actually, many are calling this a brilliant, if not a bit veiled, talent acquisition strategy and extended interview. Instead of a few hours of interviews, OpenAI gets to watch these brilliant minds work for an extended period and then potentially offer them a job to continue working internally. It's a highly efficient way to poach the best of the best. However, if you zoom out, you'll see another layer of strategy at play. OpenAI is not alone in this race. Rivals like Google and Microsoft have their own AI accelerator programs, all fighting to influence the next wave of innovators. And we've talked about how this isn't just about accelerators. Remember Anthropic's sky-high valuation backed by Google and Amazon? The giants are seeding multiple fronts at once. So the thing is, this is all about strategic ecosystem lock-in. By giving startups early access to their specific AI models and tools, these giants ensure the next generation of great companies are built on their platforms. They are essentially building a competitive moat around their technology, a moat made entirely of dependent startups. It leaves you wondering, in a world with over 1,300 AI startups already valued at over $100 million each, why are these tech giants fighting over ideas that are barely on a napkin? The battle isn't just for today's market share anymore. It's a race to own the future, one pre-idea at a time. Speaking of high-stakes battles, our next story shifts from the corporate world to a criminal investigation where the fight is between cutting-edge tech and old-school detective work. In the hunt for Charlie Kirk's suspected killer, the FB, I found a clue so strange, one expert called it very unusual. It wasn't a fingerprint or a palm print. it was a full forearm imprint left at the sniper's nest. Now, get this. The skin on your fingers and palms is covered in unique patterns called friction ridges, which is what makes a fingerprint so reliable. But the skin on your forearm is different. It doesn't have those ridges. So finding a clear imprint like this is both incredibly rare and forensically challenging. Investigators believed this could be a game changer. With new 3D scanning technology, a forearm print can become a reservoir of information, potentially unique enough for an ID if it has specific scars or markings. The potential here isn't just taking a picture. Forensic 3D scanners capture millions of data points to create a high-resolution digital model. This allows investigators to map unique characteristics like scars, moles, and even hair follicle patterns. Research shows this tech can even pick up the subtle impression left by the weave of a shirt sleeve, turning a seemingly useless smudge into a goldmine of data. This situation presents a fascinating duality. On one side, this groundbreaking potential, while on the other, a deep skepticism within the forensic world. Other experts say a forearm print is not a primary form of evidence. Its skin lacks unique ridges, and there's no database to run it against. One investigator put it bluntly, it's not like a finger palm print that is 100% unique. This is a huge hurdle, not just scientifically, but legally. For any new forensic technique to be admissible in court, it has to pass the Dober standard, meaning the science must be tested and peer-reviewed. With proprietary black box algorithms analysing this 3D data, it becomes very difficult for a defence team to challenge the evidence. But after all the focus on this futuristic clue, the capture of suspect Tyler Robinson came down to something ancient, a confession. It was reportedly Robinson's own family who shared information that led to his surrender. So you have to ask, what was the real psychology at play? A former FBI special agent suggests that some criminals may not be aware of modern forensics, thinking, oh, I can leave my forearm prints and it won't amount to anything. This idea is known as the next gen CSI effect, where a criminal's understanding of forensics is years out of date, giving law enforcement a powerful advantage. But another theory is far more chilling. For some ideologically driven criminals, the mission isn't to escape. Getting caught gives more oxygen to their message. As one expert noted, their main mission is to achieve the goal, which is to kill their target. The evidence isn't a mistake, it's part of the statement. And that's a crucial point because this martyrdom mindset changes the entire game for law enforcement. When a criminal isn't trying to hide, high-tech forensics can become less critical than old-school intelligence and behavioral analysis, trying to predict and prevent the attack before it ever happens. From the courtroom battle over forensic evidence, we now turn to a massive antitrust battle in the European Union. The EU just called out Microsoft for abusive practices, accusing it of illegally crushing competition with its Teams software. And just when it looked like a massive fine was coming, Microsoft dodged the bullet. And this isn't happening in a vacuum, you know? The EU is on a major campaign to rein in big tech. Just recently, they hit Apple with a massive 1.8 billion euro fine for blocking apps from telling users about cheaper ways to subscribe. So when the EU sets its sights on you, it's serious business. This all goes back to a complaint from rival Slack, which was acquired by Salesforce for a staggering $27.7 billion. Slack's accusation was simple. Microsoft was unfairly forcing Teams on millions of users by bundling it with its dominant Office products. The EU agreed and launched a major investigation last year. And believe it or not, this bundling strategy was wildly effective. By 2024, Microsoft Teams had skyrocketed to 320 million monthly active users. To put that in perspective, Slack, the company that started this whole workplace chat revolution, had about 65 million. It just goes to show you how powerful bundling can be. But instead of a fine, Microsoft just cut a deal. In a major concession, the company will now sell its popular Office 365 and Microsoft 365 suites at a reduced price without Teams included. Now, this reduced price is where the story gets really interesting. We're talking about a discount of around €2 or a couple of dollars per user per month. For a massive enterprise, that can add up. But for many, it might not be enough to justify ditching the convenience of having Teams already built in. It's a strategic move to comply with the letter of the law, but whether it truly opens the door for competition is the big question. To deliver on that promise, Microsoft is committed to creating what are called APIs, application programming interfaces. Think of these as secure doorways that allow other apps, like Slack, to plug into Microsoft's world and access data from services like Outlook Calendar or SharePoint. They're even launching a central website for developers to help them build these connections. Of course, this wasn't exactly a friendly handshake. Salesforce's chief legal officer went on the record stating that Microsoft's actions harmed businesses, denied customers fair choice, and resulted in many years of lost competition. He called the settlement a meaningful step forward. The European Union has made these new rules binding for at least 7 years. So the question remains, is this a real loss for the tech giant or just a clever strategic retreat after already getting teams onto the desktops of millions? The war for your workplace software is far from over. Speaking of giants making strategic pivots, the auto industry just saw a huge one. In a stunning reversal, Ram just hit the kill switch on its all-electric pickup truck. The company has officially cancelled plans for its full-size electric Ram 1500, a truck that was supposed to be a major contender in the EV market. This isn't a rumour. A company spokesperson confirmed that as demand for battery electric trucks slows in North America, Stellantis is discontinuing development. This bombshell admission comes after the truck's launch had already been delayed twice, but slowing demand doesn't tell the whole story. The real turning point is that the current generation of all-electric trucks is failing to meet the very specific needs of traditional truck owners. Real-world tests show that when you tow a heavy trailer with an EV truck like the Ford F-150 Lightning, its range can plummet to under 100 miles. On top of that, most public charging stations aren't designed for a truck pulling a trailer. But Ram isn't abandoning electrification completely. Instead, they're making a massive pivot to an extended range electric truck, the Ram 1500 REV. This truck has an electric generator, but it also has a gas engine on board. It's a hybrid strategy in a market everyone thought was going all electric. What Ram is doing here is creating a bridge for truck buyers who are curious about electric but terrified of the downsides. This range extender is designed to eliminate range anxiety. The Ram 1500 REV packs 654 horsepower, can tow up to 14,000 pounds, and with its onboard generator, its total range is projected to be up to 500 miles. This drastic move seems to be part of a major shakeup under new Stellantis CEO Antonio Filosa, who recently promised to make the tough decisions needed to re-establish profitable growth. When we place Ram's delay alongside its competitors' struggles, the strategy becomes clear. It's a brilliant second mover advantage. Instead of rushing to market first, Ram watched its rivals struggle with real-world performance issues. Now, it can release a product that directly solves those problems, protecting its brand identity. This decision lands as the entire auto industry grapples with slower than expected EV adoption, and as the Trump administration looks to unwind initiatives from former President Joe Biden that pushed the industry toward electric. And this isn't just about reading the room on consumer demand. It's also a strategic hedge against political and regulatory chaos. Automakers face wildly different rules depending on who is in office. These shifting regulations, known as CAFE standards, come with massive financial penalties. In fact, Stellantis has faced over $425 million in these penalties since 2022. By pivoting to a range extender, Ram can meet fuel economy targets more flexibly, no matter which way the political winds blow. Ram's public retreat from a flagship all-electric truck is a massive signal that the EV race is being re-evaluated at the highest levels. Is this just a problem for Ram, or is the entire all-electric truck dream starting to short-circuit? While Ram is hitting the brakes due to market uncertainty, our final story is about a company flooring it straight into one of the most volatile markets of all. A company just went public after losing nearly $500 million in 18 months. And the shocker? Its stock exploded on day one. Gemini, the cryptocurrency exchange founded by the Winklevoss brothers, just hit the Nasdaq, but buried in its registration filing is a jaw-dropping number. The company posted a net loss of $159 million in 2024, and in the first half of this year, it lost another $283 million. This is a classic example of what's known as the profitless IPO paradox, and it's all about betting on future growth, not past performance. Gemini's own filings reveal their strategy. They're trying to diversify their income away from just volatile trading fees, which still made up nearly 70% of their revenue last year. The plan is to introduce new products and expand internationally. Despite all that red ink, its IPO raised $425 million. The stock was initially expected to price between $17 and $19, but demand was so high it ended up pricing at $28. Then it opened for trading at over $37 a share, a staggering 32% jump. So what is Wall Street betting on? Interestingly enough, there's a term for it in the industry, the Winklevoss premium. The Twins' entire brand is built on a narrative of being the trustworthy, regulated players in a Wild West market. They've been pushing the idea that the revolution needs rules for years, and going public on the Nasdaq is the ultimate validation of that strategy. This IPO is a landmark moment in that long battle. The company now holds over $21 billion in assets, and it seems investors are betting on the future, not the past. And it's worth noting who these investors are, because it's not who you might think. While the headlines are splashy, the real story is about institutional money. This detail is crucial because it shows their core business is focused on providing sophisticated, secure services for big players like hedge funds and asset managers, which is a much more stable, long-term strategy. But if that was just the appetizer, the main course was just being served. On the morning of their big debut, the Winklevoss twins went on the record with an absolutely stunning prediction. They see Bitcoin's price reaching $1 million within a decade. We're seeing the Winklevosses make this wild headline-grabbing prediction, while at the same time, their real growth engine is the quiet, behind-the-scenes institutional business. It's a classic two-pronged strategy. Use the public hype to build the brand, while the real money is made serving the big fish. It all leads to the ultimate question, is Wall Street finally buying into the crypto revolution, or is this the biggest gamble yet?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.